Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is Wednesday, July 12th. This is host Richard Benuli. Today we have Katie Stockton, Peter Boockvar, and Ira Harris. Katie is a chartered market technician, CMT, founder and managing partner of Fairlead Strategies, an independent research firm and investment advisor focused on technical analysis. She's also the portfolio manager for the Fairlead Tactical Sector ETF, TACK symbol. And prior to forming that company, she spent several years, more than 20 years on Wall Street, providing technical research and advice to institutional investors, most recently serving as chief technical strategist for BTIG and chief market technician at MKM Partners. She's also worked in technical strategy teams at Morgan Stanley and Whit Soundview. And she frequently shares her views as we see her on CNBC as well. Peter is the Chief Investment Officer for Bleakley Financial Group and Advisory. He has a newsletter product called the Book Report, BOOCK report.com, offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and a stint most recently. Welcome, everybody.
Thanks so much, Richard.
Yeah, we thought we'd do an interesting discussion today to bring fundamental analysis and technical analysis together. So maybe we can begin, Peter, with your macro view on the economy and the financial markets.
Sure. I think, and I'd love to hear Katie sort of talk about this from a chart perspective, is the market, the stock market seemed to have bottomed in October of last year. And that coincided with the last 75 basis point rate hike from the Fed. And they've been slowing that down ever since. So it seemed like this rally, from a fundamental thought process standpoint, was we don't want to miss the Fed is done rally. And interestingly enough, it was late October 2022, the dollar peaked out just as the Fed was downshifting their interest rate increases. So both seem to be working still to today, where the market continues to rally and the dollar is now breaking down, just as we get a softer than expected CPI, reinforcing that, yes, maybe the Fed will raise rates one more time at the end of the month, but that's probably it. Now, past that, I think more relevant of a driver to markets is how long will rates stay at these high levels, even if they don't go up any further. So while we're getting the good news on inflation, I think we're going to have to deal with a higher interest rate regime for longer, with the possibility of upside surprises on the long end of the curve, because I think the short end is much easily definable in terms of range, because we know where the Fed funds is going to go from here. But the long end, I still think that there's risk to the upside. I still think that the U.S. economy has not felt the full force of a higher cost of capital for longer. So I expect economic growth to continue to slow as the year progresses. And that after this, okay, Fed is done equity market rally, we're going to shift focus to corporate earnings, because that's really the next sort of reality / gut check for the market as we digest this post-SVB higher rate world. And I think that's where we stand. So there's this interesting tug of war where equity markets think that the path is all clear because of the Fed almost being done, even though they're still doing QT, and QT is a major liquidity drag that I think is now just going to start being noticed again, because the size of the Fed's balance sheet is now below where it was before the expansion in response to SVB. So that liquidity drain could start to get more notice in the weeks and months to come.
Interesting. And your thoughts, Ira?
Well, I certainly agree with that in so many ways. And again, being in the global macro world, that Peter, of course, is certainly resides in, how this will affect a myriad of asset classes around is very important. And I know Peter put out a piece following the Canadian Bank Canada raise today to 5%, which was an interesting, when you read their statement, I wish the Fed would write like this, because it's so clear and they look at everything. I mean, right, and Peter writes about other things coming out of that, but the global financial conditions have tightened, this I'm quoting, with bond yields up in North America and Europe as major central banks signal further increases may be needed to combat inflation. So you really get a flavor that they're watching everything that's going on in the world. I mean, we saw that out of the last night we had the New Zealand, and New Zealand held at 5.5%, but there's a lot more focus on the rest of the world, which always amazes me that the Fed statement, I know the dual mandate, which I think is one of the worst pieces of chicanery that exists in the world, especially when you're the world reserve's currency. And I'm really amazed we don't hear more from the Fed about global financial conditions, which fits what Peter's talking about, because now we're going to, even if we're higher for longer, that's fine. But what's going to be the impact, of course, with quantitative tightening and its impact? And Peter talked about back in October, right? The dollar in September, October, the dollar got up to 114 on that dollar index. Interesting that was that high. And as Peter pointed out, the S&P low in October coincided. So the stronger dollar, and I know Peter and I did a podcast back then, we were talking about the strain the stronger dollar was putting on the global financial system. And there it's, we talked about that forward looking. In hindsight, it's absolutely borne out, because the dollar is weakened. The stocks have found a reason, along with a few others, to certainly find a reason to rally into the face of it. So all of these are very important. Quantitative tightening and the tightening of financial conditions are certainly taking place. And interestingly, that all the other central banks deal with tightening financial conditions, and they are tightening, regardless of what the S&Ps are doing or the Dow Jones or whatever. Financial conditions are tightening. What their real impact is going to be, we don't know yet. We're all in the middle of trying to judge that out.
Great. And Katie, you've graciously put together some charts. Maybe we can look at a few on like the interest rates, yield curve, or 2-10 bond spread for the U.S.
Yeah, of course. And as you know, I look at the market from a technical perspective. So I'm really just looking at price to understand trends or yield. And we have various technical indicators that we're using as well to help us enhance our work. And you'll see that this is the S&P 500 on a monthly chart, and it's against the 210 spread. Notice that here's our downdraft, of course. We have these little numbers floating above and below the line, and that is the DeMark indicators. The DeMark indicators are really very helpful in gauging what would be trend exhaustion. Let me make this bigger for us here. So if you see the 13s down here, those suggest that this is overdone on the downside, that we should get some kind of rebound. Now, that rebound is not stock market positive, right? Because with the recessionary environments denoted in red here, you do tend to see a weaker equity market. And, I think it was Tony Dwyer who said something to the effect of, you don't see the equity market or S&P 500 index bottom before recessions. It's either during, or I think in one case it was after. So that's something that's in the back of our mind, of course, from a technical perspective. But we are not trying to be ultra predictive in our work. We're just trying to stay on the right side of the market. And right now we have this intermediate term uptrend Of course, it follows 2022, which was a bear market cycle. To Peter's point, the market did bottom in October of 22, and it really hasn't looked back when you look at the S&P 500 or the NASDAQ 100. However, if you look at any other benchmarks that are not quite as concentrated in the mega cap stocks, things like this, which is the IWM ETF, it represents the Russell 2000, a smaller cap benchmark. The uptrend really just wasn't there. And that's because breadth wasn't there, meaning the participation was not broad in that uptrend, but rather it was narrow to the mega cap. So it's been a really, I'd say, difficult market environment, at least up until May, which is when we saw breakouts above certain thresholds in our work by not only the IWMs above its 200-day moving average, but for us, this was a major breakout for the S&P 500 index when it cleared this shaded model, which is called the cloud model or Ichimoku. It's a Japanese model, and it gives you a sense of what the prevailing trend is at any given time. So it still had the prevailing trend as being lower up until about May. And you can see the nice follow through that has ensued. So we just want to stay on the right side of the momentum, which has been to the upside now for more than a couple months. And we want to ride it until it falters. One way we decide whether it's faltered or not is to see our indicators turn down. So if you were to look at this, which is a stochastic oscillator, when it comes back below 80%, we call that an overbought sell signal. And that's something that we would use as a trigger to reduce intermediate term exposure because of those sort of macro risks. The risks from a technical perspective are actually more surrounding sentiment, market sentiment, which of course is really one of the major drivers of trends and momentum. It's not just what's happening, it's how do people feel about what's happening. And by some measures, the sentiment is overly bullish, and that tends to give way to like a fragile environment, right? Where you have overly bullish sentiment, that means people have gotten a little bit greedy. And then as soon as they see momentum downtick, i.e. the stochastics come back below 80%, you'll see quick and potentially deep corrective phase. We suspect that the S&P could even come back into this cloud at some point before year end. Maybe it's when seasonal weakness manifests itself, September, October, something of that nature. And because of that, we want to be somewhat non-committal to this uptrend. And the other thing I would point out pertaining to what you all were saying is that, in this environment, we feel that the market may not be in this secular bull trend anymore, in the same way that yields are no longer in a secular downtrend. We feel that a range may have unfolded. And you can see that on this monthly chart of the S&P 500, where this cloud, which was previously working its way higher, kind of moves into a flattened range for much of 2024 and 2025. So we believe that the intermediate term swings are going to be what we need to focus on to make money.
Well, that's great. Any interesting value adds that you could mention on perspective, Peter, to those charts?
Yeah, well, fundamentally, it makes a lot of sense. Like people are used to very short moves in the economy, in the economy, in the sense of the housing market, was like, sort of like a slow bleed initially, and then things really fell off a cliff. Tech stocks collapsed, and it wasn't until after that the impact in the economy took hold. I think, and getting back to this higher for longer, just to understand this higher for longer, is that every single day, if you're a household or a business, if you're a household and you have an adjustable rate mortgage that's coming due, that rate is resetting at a much higher level. If you're a business that has a loan coming due, it is resetting at a much higher level than a loan that is maturing. Every single day, somebody's balance sheet is breaking. Doesn't make it on the front page of the Wall Street Journal. It's sort of behind the scenes, and it's happening tick by tick, nick by nick to businesses and households, to the economy. So to me, this is going to be sort of a prolonged economic impact that's going to take time. People like to look at the maturity wall when it comes to bigger companies, when they look at high yield debt or even investment grade or the like. And a lot of it doesn't really hit until 2024, 2025. But 2024 is only 6 months away. So just by the Fed being very sort of stubborn with inflation, notwithstanding the moderation, this higher rate environment after 15 years of essentially zero is going to take time for us to get used to and adjust to. I mean, that's why bankruptcies are at the highest level since 2010. It's because people's debt, somebody's debt's resetting at a much higher rate. I read last week a hospitality company that had to hand back the keys, I think 18 hotels, because they couldn't stump up for more equity, and the banks foreclosed on it and they handed it back. And that didn't make the front page of the newspaper, but it's happening every single day. So that is what gets to, I think, sort of this longer term, more elongated trading range, because the economic impact of this, to me, is going to be very drawn out as well.
Do you see the same evolution, Ira, on that?
Well, I'm going to push back against Katie a little bit. And it's in looking at that 210, because I monitor the 210 very closely. And usually an inversion of a yield curve, and I've studied this from the fundamental, not the technical. An inversion is difficult for the stocks to rally in traditionally, as well as other commodities, especially gold. If you see an inverted yield curve, and we can go back to 2007 when the curve inverted to -6 for about 3 days before it turned and everything else started to fall apart post, but it was signaling that something was definitely wrong. So here we are at this level, and yet the stocks globally, and I'm looking at 20 different curves right now of 210s around the globe. And I think 93% of them are negative or inverted. Now, interestingly, and here's where I'm going to push back a little bit. Last week or a week and a half ago, we saw something interesting, because since March 8th, 9th, and 10th, when we had the 3 banks go under, and all the momentum players were short the 2-year against the 10 because it was the easy momentum trade, because the Fed kept talking hawkish and they kept putting it on until that week. So we went from a high or a low, depending on how you look at it, of -108 and change all the way to -28, which was quite a move. Last week, in the move as the banks have settled down, we went and made a new low on that 210 at 109 and change. And yet by the end of the week, we had actually done an outside, what some technicians would call an outside reversal week, because we closed at, I think, -87, which was outside the previous week's high as I'm looking at it. So that was an interesting move. And yet the equities, of course, had a sizable rally. Now, I'm a believer that when the curve will steepen back, it'll be bullish in the short term for the equity markets, because they'll look at it as a sign of relief. And interestingly, even though we saw that movement last week, unlike the week of March 8th, 9th, and 10th of 2023, the bank stocks all performed admirably. But Peter, we did that podcast on your private podcast that week, I believe, or the week following, where we actually talked about don't be short the 2-year, because if you're going into a banking, I'm not going to say crisis, but concerns about banks, the last thing you want to do is be short the 2-year. And it bore out. And now we've retraced it, and yet we're coming back here. And this time the banks aren't faltering. So we saw some interesting, that's the only, I'm not even pushing back, Katie. I'm just pointing out, I'm an amateur technician. I think I was probably trained by this guy, Howard Green, who was one of the best ever from high frequency. And he was just, I paid a lot of money for that education. But I do watch for things like that. And so that move back, and we're seeing it's kind of sustaining itself, because I think this morning we're still at -84. I mean, these are really importantly inverted curves. And as I tell people, I said, the amazing thing about gold is gold should be at 1580 to 1630 in an inverted curve world like this. But as Peter and I have talked about, I don't know what these mean anymore, especially during the realm of QE and QT. We don't know. We've never been here. So yes, I look to the technicals, and the technicals will be very important because I have no fundamental past history in which to really look at this. So, but that's all. I wanted to raise that issue.
Well,
Yeah, I certainly don't disagree with you for sure. Just I think it's more of a matter of time frame, right? And it's often the case when anytime that you feel like the technicals and the macro inputs diverge from one another, it really does come down to time horizon. You know, all we're calling for here is a few weeks of upside follow through and a downdraft to, you know, sort of give up a lot of those gains. It wouldn't really sort of disrupt anything that you're seeing here in the 2s, 10s, you know, information. In fact, to your point, where they come off of the or where it comes off of the lows, you do tend to still get a little bit of a push higher, but we have already come off of a bear market cycle. So also to your point, this is not the same environment, right? So we don't ever really have an exact comp, and if we did, it would be such a small sample size, right? So we can't always depend on sort of the macro comparison over history as giving us guidance necessarily, because it's been different. And we just don't have a great sample size. But for now, momentum is there. I think we can all agree on that. And, you know, once we lose momentum, I think it could be significant because, you know, the trading range seems to have a hold.
So Katie, as part of the potential further narrowing and net inversion, you see potential upside in the 10-year yield to isolate that piece of it.
Well, so actually, let me get to that slide because it's really kind of important, right, from a technical perspective, not just a macro perspective, in that we feel we have a secular shift. So to your point of higher or longer, you know, we've come out of this massive multi-decade downtrend channel for treasury yields, and it tells us that the bias is now to the upside. Within that context, we can get a year, 2 years, even 3 years of, you know, sort of counter trend activity. This year has been a counter trend type of move following that big breakout. And we think that that counter trend move will keep hold here in the near term. But then after that, we should see some kind of higher low for treasury yields, and they'll resume higher. Where that happens, we don't know. There's very good support around 3.25 for 10-year yields. And it would sort of make sense based on some of the signals that we're seeing that we could get back closer to that before resuming higher, or at least remaining firm. But we agree that it's a pretty major shift, and it takes us out of you know, some of the older, more valid comparisons, if I can find this here, where you can run the different asset classes against one another, and you'll see, I can't find my chart. You can see that there's like really no way to say, okay, well, this environment is just like this past environment, because if we take this is the dollar index, crude oil in the bottom, and then S&P 500 and 10-year yields. Well, just the yields sort of divergence now is enough to suggest that we are in potentially a new normal type of environment, at least, you know, going back to the 80s.
See, Ira, this is very interesting in that we are, you know, there's, look at the move in the yen the last week. And I read this article in Nikkei News, like hinting that the next BOJ meeting, they could be widening yield curve control. And that could be the catalyst to get the 10-year back above 4 and sort of prolong this higher for longer on the long end of the curve. Maybe the BOJ waits a meeting, but it just seems that the BOJ is reaching a major inflection point here with the new governor.
You know, Peter, can I, Richard, can I?
Yeah, go ahead.
So one of my favorite charts to look at over the last 30 years has been the yen yuan. And Peter, that brings us back. What the hell was Yellen doing in Beijing? And meeting with who she met, you know, the first meeting was with Yi Gang, who is the outgoing head of the PBOC, and she only met with Pan, who's supposedly the new head of the People's Bank of China. But what was she doing there? And I come back, and okay, you know, we didn't prep for it, but if you look at the yen yuan chart, and you go back to 1993, December of 1993, the yen yuan was 19.22 yen to the yuan. On January 1st, 1994, China devalues the yuan by 50%, from 5.8 to the dollar to 8.7 on the same day that NAFTA started. Katie, your eyes are going to roll because you're now sitting with two macro fundamentalists in the world of tech. I know this is all.
Peter has seen this before when I start to glaze over.
So, and where are we today, Peter? 30 years later, we're at 19.30. And it seems to be that when the yen weakens, the Chinese don't like it. So what we don't know, did Yellen discuss with the Chinese are concerned about the weak yen? Because Peter, you and I have now discussed in several podcasts, and Louis Gavay especially, is the yen, to use Michael Howell's words, being weaponized in an effort to reshore out of China into Japan. Now, there's a piece today by Richard Katz in the FT that I can't disagree with more, but I like reading his argument because it forces me to think about things, which is what good op-eds are really for. You have to think about things. But we're sitting right in the middle of this same range. You think about that, 30 years on. And as soon as the Chinese devalued, the yen yuan went down to 12.5. The only time that we've really seen intervention, and everybody's talking about intervention now. Peter, you and I have talked about the yen. We're starting to see the movement in the banks that you and I, in the Japanese banks. Tokyo Mitsubishi looks good, but until it gets over 820, I'll let Katie do the work on that. I'm not excited about it. I mean, we're at 775 today, but things are definitely going on. And interestingly, the conversation, what was discussed, and are the Chinese just so concerned about the weakness in the yen and it being allowed and pursued by the US? Because we saw this, by the way, in 1998, June 13th, 1998. Bill Clinton is headed on his way to Shanghai and Beijing with a plane full of US CEOs to do business. And while they're going, what happens? The US Treasury prods the Ministry of Finance to actually start intervening to buy yen. The yen was too weak. The yen was at 137, 138. And it evidently was the Chinese were concerned. And then the yen yuan got up to like 1750, not quite to where we are now, but we keep playing in this area. And I know they're going back to the Adam Tooze piece from about a month ago, and it caught me by surprise. China is the largest exporter of automobiles in the world, followed by number 2, the Japanese, and number 3, the Germans, of course. And the Germans are taking a beating here. I mean, every number I see out of, and rightfully so, because the euro, you want to see the euro yen, the Japanese are getting a huge competitive advantage. So what's the concern here? What the technicals, Katie, because you're a big proponent of this, I can tell. If you're right at the wrong time, you're wrong. So our job is to try to catch them together. And I think that's what Peter and I are pushing you at, because let's catch them together, because I don't want to be wrong. I think that this is coming, but how do we time it? And that's what really good technicians like yourself do.
Great. And just could we do a focus also on the commodities? Katie, you put together a few charts on some of the commodities if you wanted to relate those charts.
Yeah, of course. I mean, we do tend in our work to be a little bit shorter term, I would say, in our focus, because that's where we have the most interest, I'd say, from a technical perspective. Although in our investing and our ETF, we tend to be more long-term in focus, because that's usually the right way to be, eliminate some of the noise, right? But with gold, we have sort of contrasting indications over different timeframes. This is a long-term trading range for gold. So it's somewhat of a longer-term neutral bias with that in mind. But you can see the strength of this final resistance level. It's at 2063. A breakout above that would, of course, resolve the range to the upside. We have seen a shift in long-term momentum throughout this uptrend to the upside. So that gives gold the opportunity to make another run at that resistance level. This corrective phase shows indications of maturing. So oversold indications are now giving way to a little uptick in short-term momentum. So we are short-term bullish gold. We're also long-term, I'd say, constructive gold with the potential for that resistance to ultimately be retested, even though we have seen, of course, a corrective phase on weaker intermediate term momentum. The key here will be that gold manages to hold support. And the support that we're watching is derived from a Fibonacci retracement, and you'll see it here at 1905. The reason that that's a very important level, the nature of the Fibonacci, is if you see a 38.2% retracement, that's of this uptrend, taken out, the targeted level often becomes the 61.8, and you can see that's well below 1,800 per ounce for gold. So we have a bit of a stop loss on gold. If the reaction just isn't there to the oversold indication like we think it is, then we're going to react to that. And you'll see that that's in falling with sort of the dynamic nature, right, of how we're approaching markets. We can't predict where gold is going to be in 3 months, but we can certainly put, probabilities on our side by using these indicators and at least have defined risk reward metrics using the key levels on the chart. We have for crude oil what appears to be a sort of a move from a downtrending environment to now a trading range environment. There are some signs of downside exhaustion in those same DeMark indicators here that we're finally seeing a reaction to. So we suspect crude oil has a little room into the low 80s within this range, but the range itself lends a neutral bias. So more of a neutral bias for crude oil. Copper now has very good support between a Fibonacci retracement. There's also some cloud levels in play here, but you'll see that if it does react again here to this recent oversold reading, we also have an oversold reading on a short-term basis. We would expect to see a breakout for copper. The resistance isn't shown here. It's on the daily chart, but it's right around 386.77. So a breakout above that would naturally be a positive development for copper, and therein also probably Chinese equities. If you look at the dollar index, just to kind of support or not support, depending how it goes, what's happening there, you'll see, and this is interesting, we had the downtrend unfold in late 2022, and then a range ensued. And you see the range has narrowing peaks and troughs to this extent that we have this now triangle formation that was resolved to the downside. It's actually a pretty high probability technical formation or setup, and it does suggest that the dollar index will move lower and that it will test this support level of 100.8. And then below that, you start to say, okay, well, this trading range was probably a consolidation phase within this broader downtrend. So we would expect continued sort of dollar weakness with that kind of breakdown, not just near term, but probably at least intermediate term. So those are the things that we're watching.
That's great. And any thoughts, Peter, on the commodities, oil, gold, copper, and the US dollar?
Yeah, I mean, the dollar, just to say again, the rally and the subsequent decline coincided with attitudes towards the Fed. The dollar index bottomed in June 2021 at around 90 when Jay Powell said, we're finally thinking about tapering QE. And that's when the dollar took off. The dollar topped out right around within days of the Fed's last 75 basis point rate hike. So here we are now, the Fed is one hike away from being done, particularly with the CPI figure that we saw. And the dollar has sort of followed that. I mean, when you look at the dollar's competition and you see these other currencies that are doing so well against the dollar, it tells you there's something wrong with the dollar. And I can also throw in, of course, the US budget deficit as a percent of GDP is now at 8%, which usually you only see at the depths and bottom of a recession, and we haven't even started a recession. So the finances of the US government, which no one cared about for 40 plus years, now all of a sudden I think begins to matter, and that could have further negative influence in the dollar. I think it coincides with gold, which trades great. When you think about all the stuff that's been thrown at gold, particularly in 2022, with the very sharp rally in the dollar, the most aggressive interest rate increases in 40 years, and gold was flat in 2022. That's an impressive performance. And now I think, and to Katie's point, gold is trying to get some legs again here at the bottom end of a range. Well, it's coinciding with the Fed may be done raising interest rates after one more. And if oil gets back up, and this also ties into the problem the Fed has, is because if commodity prices start to bounce, which you think if the Fed's done raising interest rates, you should be buying commodities. It makes perfect intuitive sense. Well, if oil goes to $85, that downward pressure on headline CPI starts to reverse higher. Therefore, in turn, while the Fed's not going to be raising, keeping them tighter for longer and drawing out this sort of economic adjustment and getting back to the theme of a long-term trading range where at 20 times earnings with high interest rates and earnings growth that are falling, it's tough to get a sustained bull market here. And we'll see whether now we're at the upper end of this trading range. Today is going to be a really interesting day here on how we close, because we've sort of rallied into the hopes of a benign CPO, which we got. And we'll see what the news reaction is by 4 o'clock. But a lot of this stuff seems to be coming together, both fundamentally and technically, of interest.
And your thoughts, Ira? I know you've mentioned a lot also on the U.S.
Well, Peter gets right at it, because if we see the curve, the 210s steepen, will it be because of something we haven't seen in a long time, which will be a bear steepener in that the long end? Because, I've argued this with Rosenberg on this podcast. I've argued it's been a while with Lacey Hunt. And again, they're going to be right. It's a matter of timing it. But as I know that Peter says this to his clients, why would you extend your duration of U.S. debt for exactly what Peter talks about? Because the cost of financing this deficit is going to, it's doing it now, but even more as we hit 2024, is going to rise dramatically. And as my dear friend, not the Speaker of the House, Kevin McCarthy, but my dear friend over almost 50 years already, oh my God, as we've discussed, once the interest cost of the debt exceeds military defense expenditures, you've got a real political issue in the United States, because now you're going to have to make real decisions, which we haven't seen anybody make in a long time, as to what you're going to do with discretionary spending. And now we're going to experience that coming into the 2024 election, which is another theme. But going back to what Katie presented us with the gold, because when I look at the gold, I know the great support levels. And with what the inversion has done, we should be down at those levels. Because you can go back and, because if you want to compare this, and I lived through it, I'm older than everybody in this room by a lot, but I traded through the Volcker years. I started in this business in 1977. My academic work preceded that. But the inversion of the curve, now, of course, that was dramatic, but of course, the debt load was 39% of government debt. But it was the inversion of the curve that broke the back of the gold market. It took it a little while. We're not getting it this time. We're hanging up at these levels. And that's one of those, what's the word I'm looking here, okay? When you get a discrepancy, there's technicians. When you get
just a divergence?
Divergence, thank you.
Yes.
When you get that kind of divergence, that makes my antenna go up. And then Katie will say, well, this 1905 area is a very critical area. Okay, I can define it. As traders, Peter and I, our objective is to limit the amount of risk for the greatest return. If I'm doing my job well, that's what I'm supposed to do. So, okay, if I can define that, because everything in the world tells me that gold should be getting hit, and yet it keeps battling, and fighting for its life. Now we may walk in one day and gold may be $100 lower. but I would kind of be shocked because it's already withstood this massive inversion. And again, I go back to what we talked about that last week. We made a new low for the 210, meaning we're at 109, and then where we close. So now I'm going to be, and is that steepening that took place, is that because people really do not want to extend out their duration of U.S. assets? Why should I? I can buy it. I can buy a 1-year treasury bill and get 5.5%. Why do I want to extend out my duration into a terrible period of where they're going to have to come to terms about what to do with the financing of the debt? Again, it was never the debt ceiling. It was how do we finance what we already have taken a bite of.
Great. And the last topic for today is on emerging markets. We've done some recent podcasts with Dr. Mark Faber and Louis Vincent Gave of GaveCall, and they indicate a bullish bias towards emerging markets, in particular Brazil, Indonesia, Argentina, Mexico. Any thoughts on that? Katie, do you have charts that you could show possibly?
Yeah, we started covering the international equity markets using ETFs because we had a lot of people that were interested in them and trading them. Let me show you. I'm hoping I have a chart in here of just EEM or emerging markets more broadly. Okay, so we have not EEM, but we have at least KWEB, which is a China Internet ETF. And it's, I think, really sets the tone for broader emerging markets, just in terms of kind of like risk on, risk off. And we've seen a distinct, I'd say, loss of long-term downside momentum. And you can see on this monthly chart, this is China specific, that it has improved since these lows were established in 2022. It's still too early to say this is definitively a basing phase from which we'll see a cyclical up move develop. But there are indications on a shorter term basis that we should see some rotation into the emerging markets more broadly, especially if we get the dollar breakdown. The relative strength should improve pretty dramatically. Other markets like Brazil, you can see have done really quite well. This is actually poised to me to break out above some previous resistance levels. So you can really make a strong case for emerging market investing. And if we get the dollar index breakdown, well, then we'll have a catalyst for even outperformance. And the other sort of positive takeaway there would be, it's hard to imagine, emerging markets outperforming in a weak tape for just U.S. equities. So I think that would all be sort of a bullish development. We also have overseas, looking at Japan. Let's see if we have this one. Look at this breakout. This is the Nikkei 225. You can see it's stair-stepped higher over history, and it has a pretty fresh breakout. It's not new all-time highs necessarily, but it's still bullish, and you see relative strength has done quite well. It probably stretched in the near term, and you have the currency impact, but we just see that there's a marketplace that is lending us more opportunities, not just in different countries, but also different asset classes. So that's like the positive takeaway from all of this, is that, well, maybe the S&P 500 will continue to be challenging, and that we have a trading range unfolding longer term with just a lot of cyclical moves to navigate. But now we have opportunity in other asset classes, and commodities and fixed income, and also international equities. So we can make a case for rotation into emerging markets.
Very interesting. And your thoughts, Peter, on the emerging markets in Japan?
Yeah, well, on emerging markets, from a fundamental standpoint, I agree. When you look at over the last couple of years, who have been the most prudent central bankers? It's been Mexico, it's been Brazil, and it's been others that have many decades of experience in dealing with inflation. I mean, the Mexican peso has been a rock star against the US dollar. And that's in the face of a socialist president, drug cartels, and so on, because I think Mexico is going to be a big beneficiary of a lot of manufacturing onshoring, and their central bank has been very prudent in raising interest rates. Same with the Brazilian central bank. So we actually are very bullish on emerging markets. We're actually playing it in some equity markets, but also in emerging market local currency bonds. So willing to take that local currency sort of anti-dollar exposure in addition to owning sovereign emerging market bonds, which I think is really attractive. So I agree completely. And if you do get a lift in commodity prices, some of those emerging market commodity countries like Mexico, like Brazil, like Argentina, and some others could get a lift, another lift from that catalyst as well. Japan, I mean, Ira knows this. We've both been bullish on Japan for a while. Japan has been very interesting story, particularly this year on the China reopening, because Japan is a beneficiary of course, China reopening itself, just because of its location in the region. But Japan is all of a sudden becoming a beneficiary of company desire to diversify their supply chains. And they're willing to open up factories in Japan. And Japan's even expanding their semiconductor presence as the world wants to diversify from Taiwan. So Japan is a very interesting story. I think it'll be interesting to see what happens to Japanese stocks when I say when, not if, but when yield curve control gets widened again. But I think Japanese stocks could trade outside of the consolidation that Katie mentioned, and this could be a catalyst for further consolidation. But I think past that, Japanese stocks could resume their upward trend, particularly with the bank stocks, which Ira mentioned. We're long also Sumitomo Mitsui Financial Group. I mean, the Japanese bank stock index is still down 85% from where it was in 1989 in nominal terms. So between structural governance changes, stock buybacks, dividend increases, reasonable multiples, and a play on Asia's economy, we remain and stay long Japanese stocks.
Awesome. And Ira, I know you've had a focus on Japan, especially the banks.
Yeah, Peter and I have been on this both, and with Louis Gavay, and Rosie has definitely, everybody's been bullish, and rightfully so. We actually caught that one pretty well, and the Japanese banks especially. Still like, and as Peter talks about, Mexico, Brazil, Malaysia, Thailand, they've learned things and about how to counteract the U.S. And in fact, because their demands for dollars were so great, they had to get out in front of the U.S. because they couldn't afford to have their currencies weaken. Where the previous playbook was weaken your currency to build exports, it hasn't really done them well. And interestingly, I was watching Weston Nakamura talk about, he interviewed Michael Howell, and they talked about China, especially, and the yen. And Nakamura has done really a great thing in his deep knowledge of the inner workings of the Chinese government. But he talked about Yi Gang, who's been pushed out, Yi Gang, who's been pushed out as the head of the PBOC. But back in April, I believe, Yi Gang gave a speech at the Peterson Institute. And he said a couple of things, and Weston is probably right about this, why Yi Gang got pushed out. But Yi Gang gave a speech and he said, markets will defeat central banks, meaning intervention is a waste of time. Now, this is coming from the head of the People's Bank of China. And he also said, in deference to Peter, this is absolutely right. And I've believed this for a long time. Flexible exchange rates sustained external chaos situations. So if your currency can move, it's always adapting rather than the old school thing, which was hold the currency, because I have to keep it strong or firm against the dollar, and then figure out that you can't do that anymore. So the fact that everything has been floating through all these periods, I think, has worked to that great advantage. And the fact that the Bank of Mexico got out in front of everybody, that the Brazilian real, has done so well, even with Lula. And I had that discussion with Carolyn Miller when we did that. And I said, why Brazil I thought would really perform. So I think this all sustains itself. And there's just so much more going on, but we are seeing that, and it's not being done with the traditional sense because the commodities haven't performed that well, which would really be the bailiwick for a lot of the emerging markets. And yet that correlation is breaking down. And I, like Katie, I'd love to see when these long-held correlations start to break down, because that's when we're going to get interesting movement and the ability to make greater profits. Those breakdowns are great, and we're seeing them. We're seeing them with the 210. We're seeing them with the emerging market bonds performing so well. I mean, the only bond markets worth being in for the last 2 years have been the emerging market bonds, and that's where they've been raising rates. So we are looking at a phenomenal environment.
Well, it's been a powerful, insightful discussion bringing together an integrated view of technical analysis and fundamental analysis. How can our listeners and viewers learn more about your work, Katie?
Probably the simplest way would be to go to our website and sign up for a free trial of our research. It's fairleadstrategies.com.
Great. And also, Peter?
So I've shifted over my writings to Substack, so they can go to Peter Boockvar at substack.com. And if they're interested in subscribing, and if they're interested in wealth management services, they can check out our website at bleakley.com and reach out to us.
Great. And Ira?
Just, well, you can find me a lot of doing these podcasts, and I'm really going to get back to writing at Notes from Underground. But I have to say, I don't know what viewers will see of this, but I would sit and do another one of these tomorrow. I know Katie doesn't have time, but I mean, this was really, to me, a format that really helps people. And whether you agree or you better know why you disagree. But the technicals plugged in with the fundamentals is a very, very, I mean, that's what I strive for. When those tools get used together and you actually, and they actually come to agree at the same time, it's a very powerful. That's as I used to say, that's when you go full tilt boogie into the market and really let it, because you can find your risk, and yet the technicals are showing you that there's momentum building and it'll go your way.
Awesome. Thank you so much, Katie, Peter, and Ira.
Thank you.
Thank you. Great to see everyone.
Yep.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.